Well, good morning. Welcome. You're watching Ask Profit here on NDTV Profit. I'm Hersh. Sayta. With me is Anushi, Vakharia. And over the next half an hour, we'll take your queries and we'll try and answer them the best we can. Of course, we'll have both our guests who will be answering all of those queries. Number flashing on your screens. You can write to us and we'll try and answer as many queries as possible today. But first off, let's quickly take it across to markets. Well, slightly soft start to the week for the benchmark itself, down around a fifth of a percent or thereabouts. There you go on your screen, a tenth of a percent, in fact, lower. A slight bit of recovery we've seen from the bottom. In terms of the top contributors, we have the likes of a Reliance, ITC, Infosys, doing decently well in trade. Reliance, of course, leading the pack, 0.7 of a percent higher on that one, of course, the largest of the large caps. And you have also among the top drags, you have an HDFC Bank, a Titan, and ICICI Bank. So banks, IT also a bit soft, and Titan within the FMCG basket. You also have certain other smaller banks which have declared numbers, or rather their provisional updates, and they are also a bit under pressure, and that's possibly why the entire Nifty Bank is down around 0.5% or thereabouts. So that's where the real drag is coming from. You're also seeing some bit of drag from the metals, the pharma, as well as the realty space, all three of which are trading in the red. If we can quickly pull the sectoral indices, there you go. So outside of FMCG, you're seeing quite a bit of pressure on most of the other sectoral indices. You look at energy, of course, trading a wee bit in the green. And maybe even the PSU, stocks. But outside of that, you're looking at, a good bit of pressure across sectoral indices. But let's focus in on one stock in particular, on the Nifty. In fact, the second worst contributor to the Nifty 50 today. And we have Titan with its numbers. Provisional update, of course, with regard to Q1 FY25. We have Mahima joining in to break down some of those numbers and give us perspective. Stock clearly under pressure, Mahima, 4% lower.
Absolutely, Hersh. So the stock is under pressure because of its jewellery business performance. Well, jewellery business grew by 9% YOY. Watch and wearables grew around 15% YOY. Eye care business around 3%. Emerging business around 4%. TCL business around 9%. And Carrot Lane around 18%. Now, jewellery business has been under pressure and has been impacted because of weakness in consumer demand on account of surge in gold prices and low number of overall wedding days that are there in Q1. Now, in terms of domestic growth came largely through increase in average selling prices, whereas buyer growth was in low single digits as mentioned by the company in the press release. And lastly, in terms of watch and wearable segment, domestic grew around 14% YOY, and revenue was healthy around 17% of overall. So wearables witnessed a decline of around 6% YOY, which is why the overall company performance also does not look very good as per its QY FY25 update. So that is why the stock is under pressure, Harsh.
All right, a weak update for Titan coming in, but I want to take it across to our guest. Let me introduce our first guest for today, which is Mr. Rajesh Palvia, technical derivative analyst at Axis Securities. Hello and welcome to the show, Mr. Palvia.
Yeah, good afternoon.
Good afternoon. I want to take the Titan, which is our stock of the day. A weak outlook as per the numbers. The stock is about 4% down. How is it looking in the charts today, and what's the outlook on this one?
So this is the fourth consecutive week where we are seeing, Titan is under pressure. And now after today's fall, now stock has given a breakdown to its important and major support area of 32.20. So looking at the near-term, short-term structure, stock structure turns on the bearish side. Stock is now slipped below to all its near-term moving averages. Stock is trading below to 50-day moving average. And looking at the monthly, weekly structure, we believe that until stock is not manages to cross about 32.20, there would be, furthermore supply pressure we can see in the near-term perspective, and possible lower target towards 3,050, even 3,000 could be there for Titan on the downside. So I think those who have already created short position, they can hold their short position at this juncture. In minor pullback towards 3,200, one can go short also with stop loss of 32.50. downside target 3050 to 3000 we can see in the near term perspective.
Right, thanks so much for that, Rajesh. Let me also take it across to our second guest joining us, Lancelot Dukuna, CIO at ValueX Wealth Connect. Welcome, Lancelot. Good morning. I want to try and take in your views with regard to Titan as well. What's your sense? Slightly soft update in Q1 FY25?
Yeah, I think it was something that was expected, given that we had high gold prices, and you've seen the way consumer spending has come off. So it was not something that was totally unexpected. And, if you look at it from a longer term perspective, valuations were a little high. So if it does come off, it does become an attractive opportunity to look at investment from the long term perspective.
All right. Now with this, we start our own round of inquiries which have come in. The first one is from Ujjwal. He wants to understand the technical view on HDFC AMC. He's holding it at the price of 3,200, and his inquiry is whether he should book profits or remain invested. I want to take it to you, Rajesh. What is your view on HDFC AMC?
I think he's making a decent profit in this investment. I think looking at the overall structure for HDFC AMC, we would advise here to hold the position as still we believe that the way stock is holding above all its important moving averages, the way stock is holding on monthly as well as on the weekly chart, we believe that there is still room for further more upside. Possible target on the higher side on a short term perspective, we can see towards 4250, even 4300 level also. So what I'll advise him here to trail the stop loss now towards 4,000 level. So until the stock not breaks below 4,000 level, he should remain on the long side of trade. Possible target we can see towards 4,300 also.
Well, 4,300 being the target, 4,000 being the stop loss. Thanks for that, Rajesh. But I'll stick with you, Rajesh, because we also have a query from Nikhat, coming in from Nikhat from Bengaluru. Well, he has invested in Raymond from a short-term perspective. The stock obviously on a tear at the moment. We saw very good action on Friday, followed by a 3% up move even today. What's the sense now? What should Nikhat do? Rajesh?
So very strong really in last couple of weeks for the stock. The way stock is now trading at all-time high trajectory. Even there is no sign of reversal at this moment, and there is no profit taking at this juncture also. So I think trailing of stop loss would be the right strategy to hold on the position, as still the way stock holding on the higher side. We believe that if stocks not slips below to 3,200 level, then possible rally can extend to 3,500 to 3,600 also. So trailing of stop loss towards 3,200 would be the right strategy to continue holding the position in Raymonds.
All right. Now, I'll come to you, Lancelot. So next query is from Ramesh from Mumbai, and he wants to know whether he should continue to hold IDFC First Bank. If you look at the last 1 year, the stock is just about 1% up. It's done reasonably. Not so well in the markets in the last 6 months to one period. What is your view on IDFC First Bank?
Yes, Anushi, I think IDFC First Bank, there were a lot of expectations from this company, but if you look at its business, it is sort of evolving into a completely consumer-driven or consumer-first-driven bank. And in that space has done reasonably well. So while the short-term results might not have been good over the last 12 months, we see that this company will face, or this bank will have a lot of upside going forward in terms of increase of its loan book. You'll see its profitability ratios have improved. The CASA has improved over the last 12 months. And given that NPAs remain relatively low, this should help improvement in net interest margins as well. So from a long-term perspective, if one is willing to wait for 2 or 3 years, I think this bank can do very well and provide you good returns as well.
So I'll stick with you here. Again, on the banking side, if you're looking, there is another query coming in from Ravi Shankar. He holds about 100 shares of South Indian Bank, and this is at a price of 34.5. Now, should he hold this or quit and seek other suggestions? What's your view on this? Do you cover this one as well?
Yes, so South Indian Bank is, mainly basically a regional bank, has been doing relatively well in its space. But if you want to participate in above average growth, one has to become a strong player, because as the conditions in the deposit market becomes tighter, lending conditions become more difficult. It's difficult for smaller banks to be able to compete with larger banks who have access to much cheaper funding, and thereby net interest margins, etc., can get impacted. So it's always better to look at some of the larger banks, whether it's a State Bank of India or whether it is HDFC Bank or ICICI or Axis, rather than remaining invested in these smaller banks.
Got your point. So, clearly bullish with regard to where IDFC is concerned, but not so bullish on South Indian Bank. Thanks for that. Let me quickly switch focus though. Rajesh, coming back to you, Ramco Cement, we have a viewer, Sumit from Doha, Qatar, who holds 78 shares at 864 rupees a piece. What's your sense? What should he do now?
So Harsh, if we analyze on the near-term, short-term perspective, stock is still in a downtrend. We are seeing that on the weekly chart, stock is making lower high-low formation since last 3-4 weeks. That clearly shows that there is sustained supply pressure on the stock. So until stock not crosses over 840, 850 zone, it may remain under pressure, and trend is likely to remain on the bearish side for the near-term to short-term perspective. If his horizon is for long-term perspective, then yes, he may remain invested. Maybe in decline, our advice would be to average out around 700 zone. That's the important and major support area on the short-term chart. So where he can either review it or he can buy some more quantity to average out the stock in the decline around 700 zone. And on the higher side, 840, 850 would be the major supply zone. If it crosses those levels, then possible target on the higher side we can see towards 950 to 1000 also, but it may take time, because still for next couple of months we believe that stock may remain under pressure only, and some more consolidation is likely to be there in the stock prices.
Some more consolidation on the cards for this one. But now I'll take next query from Mohit from Ludhiana. So I'll come to the oil space here. He holds about 1,500 shares of IOC, and this was at a price of 77. If we look at the one-year return, 77% of gains here. So Lancelot, I'll come to you on this one. What's your guidance for IOC?
So I think all the oil companies are doing well because we've been able to import crude at relatively lower prices from Russia. And IOC is no exception. Plus, if you look at the budget and the government's announcements with regard to oil marketing companies, there is a huge expansion plan in progress, and that should help improve the refining margins going forward. So I think if one is looking at a longer term perspective, one should remain invested, and maybe even if there's a decline, then you can add to your position, because over the next 2 to 3 years, we will see significant growth in the space.
Right, Lancelot, let me stick with you. We have Satya here, a viewer who wants to understand your views from 1 to 2 year perspective. Now, two companies is what he's looking at. One is Fredun Pharmaceuticals. It's 400 crore odd market cap. Not sure if you track it or not. Versus a TTK Healthcare. Now, of course, if you don't have a view on Fredun, if you have a view on TTK Healthcare, 1 to 2 year perspective, would really appreciate your view.
Right. Hersh, I don't have any sort of view on Fredun because I do not track that company, but TTK Healthcare definitely is a good opportunity to look at accumulation, because the company's business is growing, the requirement of healthcare over the next 12 to 24 months, the outlook is also good as far as the pharma and healthcare space is concerned. So I think TTK Healthcare would be a good opportunity to look at in terms of accumulating this stock.
All right. Thanks so much for that, Lancelot. Also, Rajesh, we have Rakesh Desai who wants to know your views with regard to Federal Bank, especially from an intraday perspective. Of course, the returns on this small mid-cap bank have been stellar, to say the least, over the last year or so. Your sense now, as well as from a short intraday perspective, short-term stroke intraday perspective, Rajesh?
So Harsh, for intraday perspective, structure is still on the bullish side, though there is some profit taking at higher level. But I think for intraday perspective, he should follow the stop loss of 184. That's the important level for the stock for intraday perspective. If it's not breaks below 184 level and on the higher side, once the stock manages to take out its intraday high of 189.30, then rally can extend to 195 also. But still, as we are seeing, the most of the banking stocks or bank nifty is under pressure today. So maybe this stock won't be able to perform on an intraday perspective. But yes, if he wish to carry it for positional perspective, our view is bullish for Federal Bank, as the stock is looking bullish across all time frame. And we believe on a positional perspective, yes, there could be a possibility of 205 to 210 would be the next target on a positional perspective. But at that time, your stop loss should be placed at around 180 rupees.
Okay, so a 205 to 210 target for Federal Bank. But with this, it's time to slip into a short break. A lot more queries lined on the other side. Stay tuned to NDTV Profit. Hello and welcome back to NDTV Profit. You're watching Ask Profit and you can send all your stock related queries on the number flash below. With this, we'll go to our next query. Now this is from Sarthak from Meerut and he's asking he's bought about 40 shares of Adani Power at a price of 840. So now I'll come to you, Lancelot. He wants to understand the long-term outlook on Adani Power.
Well, the long-term outlook is good as far as the company is concerned. There is a significant addition to the power capacity, and there's a focus on moving into the renewable space, so that should augur well for the company. However, when you look at valuations, valuations have been a little stretched at this point in time, and that's why we've seen the price correct from his price. But there is still some space to go on the downside if one is looking at trying to do some bottom fishing. So he can accordingly take a call as to whether to add at much lower levels or whether to exit and look for something else.
All right, standard disclaimer, both Adani Power is part of Adani Group as well as NDTV is also part of Adani Group, which is the channel you're watching. But, I'll quickly switch focus. Railway stocks, those have been on a complete tear over the last year or so again. And, we have the budget coming up. So railway stocks in focus, we have Jagdish, who's holding both RVNL as well as Railtel. Lancelot, good time to continue to hold some of these counters. Should you sell? We don't have a buy price, unfortunately. But your views on both of these counters, RVNL, Railtel?
So, Harsh, at the moment, these prices are being driven more by the momentum rather than valuations. And as long as the momentum remains strong, one should continue to hold the stock because upward momentum can drive the stock much higher. Given that we have the budget around the corner and there could be some, fresh announcements as far as expenditure on railways is concerned. So given that momentum is good, one can continue to hold, but one should be aware that whenever sentiment changes, you need to sort of exit as quickly as you can, because once the sentiment changes, this entire rise, we could see a lot of it getting wiped off in case everybody comes forward to sell.
All right, so a hold rating on this one. Now I'll come to you, Rajesh. Sandy wants to understand whether he should hold or sell the HDFC Bank stock.
So, Anushi, we have seen significant supply pressure in the last 2-3 days of trade for HDFC Bank, and now stock is almost slipped below to its 20-day moving average. So, 16, if he wants to hold for longer term perspective, yes, he may hold on the position. Yes, there could be some pressure in near term perspective, but I think long term, yes, structure is still bullish. Till stock is holding above 1550 zone, a long term trend is likely to remain on the bullish side on the technical front. So I think if he wants to hold for long term, he may hold the position even in the decline. He may add furthermore position towards 1600 kind of level. Stop loss is 1550 on the higher side. Once his stock again manages to regain above 1680 zone, I think again there would be resumption of uptrend, and then possible target on the higher side we could see towards 1750 to 1800 also.
Well, stop loss of 1550, 17 to 1800 going forward on HDFC Bank in terms of target price. Thanks for that, Rajesh. Rajesh, I'll stick with you. We have Srivalsam, who holds 1,000 shares of Aptech worth 300 rupees a piece. Wants to understand, should he continue to hold, should he sell? Well, most of the queries coming in are with regard to hold or sell, but so that's the other interesting stat which is coming through. Rajesh?
So stock has already corrected and now trading around 220 level. Looking at the near term, short term structure, still we believe that some more consolidation we can see in Aptech. Until the stock not crosses about 245, 250 zone, it may remain under consolidation only, and maybe it may take further more time to recover. Still, the trend is looking bearish on the medium-term structure also. So I think my advice would be, if you get any pullback towards 240, 45 level, you should try to exit from the stock and try to buy some other stock because still trend is still on the weaker side for medium-term perspective. So I think he won't be able to get his price in a near-term to short-term basis. So our advice would be to exit if it comes around 245 to 250. So.
All right. Now I'll move to Vodafone India. Now Granth Kohli has a query here. He's holding about 7,900 shares of Vodafone Idea. I'll come to you, Lancelot, whether he should hold or sell it. Again, hold or sell rating. What's your outlook on Vodafone India?
So I think, the recent price hike, tariff hike that has been taken by both Jio and Airtel should augur well for Vodafone in terms of improving its sustainability. However, if you look at it from a longer term perspective, the company has to reduce significant amount of its debt. There's a lot of capex that's required to be made, and it requires to raise money both from the capital markets as well as from the debt markets. In case there is any uncertainty on its ability to raise markets, that can be a significant dampener on the stock, and you could see growth then get impacted. So from a valuation perspective, while it appears to be relatively cheap as compared to maybe Bharti or Reliance Jio, it could land one in a debt trap or in a trap where you believe that this company can do well, but because of circumstances outside, the company actually begins to have financially a very difficult position. So at this point in time, one can hold, but review the position after 3 to 6 months and then take a call as to whether you're likely to see some upside on the long term or not.
All right. Thank you so much, Lancelot, as well as Rajesh, because we're completely out of time on this edition of the show for viewers. Thanks for sending in your queries. As well as, we'll take more queries tomorrow. We know we've not addressed quite a few of them, but for now, from Anushi, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit, because hot money on the other side of this short break.
welcome to the special show as we count down to Budget 2024. All eyes are working and looking at July 23rd is when the Finance Minister will unveil the full budget. Well, this show will focus on what your budget strategy should be if you're a short-term trader, medium investor or a long-term investor. To begin the show, we have to take you through what those previous budgets have done and how the markets have behaved in those conditions. Since 2010, there have been 17 budgets. 14 were full and 3 were interim budgets. The average return 1 week prior to the budget has been 0.45% negative. And this time around, remember, the markets have already rallied sharply in the last 20 trading days. The Nifty is up over 10% in the last 20 trading days as indicated. Now, does this call for profit taking or does it call for initiating fresh long positions? Chandan Taparia, Head of Technical and Derivative Research at Motilal, joins in. Hi, Chandan. Thank you for taking out the time to talk to us. If we look at historical data, the 1 week prior to the budget being announced is usually negative, flat to slightly lower. This time around, we're going into the budget with significant gains. The Nifty is up over 10% in the last 20 trading days. As we gear up, some may argue that there is a little bit of fatigue that the markets are showing. But between now and 23rd of July, how would you position a trade on the Nifty?
Yeah, thank you, Samina, for a fantastic question about the market and the budget ahead. If you look at the overall sentiment of the market, the trend is intact to positive. I believe the budget is going to be on 23rd of July, and because of that, the volatility might see some spurt. That is the first thing we need to keep in mind. The India VIX, which was at 32 at the time of election result, has corrected from 32 to sub 13 levels. But we believe that because of the budget, volatility might see some spike and it can head to our 16 to 18 zone. But if you ask about the market setup, the major trend is positive. And because of any trigger, if volatility happens, I think that will be both. Because the structure of the index is quite positive and we have seen the sector rotation and selective heavyweight stocks are doing well. At the time of elections, the index drifted all the way to 21,280 kind of level. But we witnessed a recovery of more than 3,000 points in just 23-24 trading session. So that clearly indicates that liquidity is there in the system. FIs also covered their short position. DIs are continuously buying. SIP flow is more than 22,000 crore per month. So if I combine all the data set up internal and even considering the previous couple of budgets, I believe the market has higher base. Major support for the index goes as 23,500. With this support, any small decline towards 24,000 could be bought. And overall, we are looking for an upside rally to extend to 25,000 marks. So I believe 23,500 to 25,000 will be the wider range with positive bias, and any decline could be bought in the market looking at the next event.
Right, just taking a cue from that, Chandan, in that case, of course, traders can initiate naked positions on the long or the short side, keeping the range in mind. But I would imagine an option strategy may be better direction agnostic. Do you feel like butterflies, long strangles, straddles could be a better way to play the budget trade between now and then?
Yeah, I think trading an option will be more advisable or better advice comparatively. Because yes, event is there, so we can't ignore the volatility which usually happens at the time of event. But we need to keep two things in mind. First, whatever the strategy we want to deploy, we will go with some directional to play the delta drifting. Second, your volatility is not spiked up. As of now, we are at 13.6. So we have to look at the strategy where we get the benefit of the Vega spike before the event, and after the event, the volatility will again go down. So I'll go with bull call butterfly with the view that some positive upside will be there. But again, 2 or 3 factors are there which are keeping us to think about the restricted upside. First, your RSI has gone to 70 level. FI's long short ratio has gone to overbought zone of 88. But yes, momentum is positive. That's why we are not changing the stance. We are being positive, but now the view is positive to range bound. So now what we can do, we can buy 24,300 call. So we can buy one lot of 24,300 call. We can sell one lot of 25,000 call. And we can sell one more lot of 25,500 call. So we are initiating 700 plus 500 points bull call ladder or bull call spread, or we can convert into the bull call butterfly. So the aim is to get some positive move without getting hurt from the theta decay. And that is the reason we are selling out of the money also. But again, budget is there. So we don't want to pay more. We don't want to take more risk. So we can hedge as well. So 2 types of strategy or 3 types of strategy we can advise. First, buying at the money call, selling 700 points OTM call, that is called bull call spread. Then sell further 500 points more OTM that convert to the bull call ladder spread. Otherwise, if someone is looking for butterfly, buy 24,300 call, sell 2 lot of 25,000 call, sell and buy 1 more lot of 25,500 calls. So this is how you can initiate the strategy with the view that view is positive to range bound. But yes, there are many people who believe that market has already seen the good run up. Even in this year, the index is up by around 11-12%. Many mid cap, small cap, heavyweights counter has rallied weight. And whenever there is the event, we always think about the hedging activity. So those who are looking for hedging, they can buy 24,000 put and sell 23,000 put. So one can create the hedge of 1,000 points. Even we are not expecting it to go below 23,500, but hedging is always advisable in the market. So view is positive to range bound, but at the same time, we also advise to go for some hedging activity with the view that we want to mitigate the risk and we want to maximize the return in the market.
Right, Chandan, these are times of uncertainty, and historically we've seen that the period before the budget turns markets quite volatile. And just a quick follow-up before I go to Feroz as well, at the fundamental view on what the expectation of the budget is. What sort of expiry or time horizon would these trades or should these trades be, Chandan, for July 23rd expiry, or would you say that running it for the full month may be advisable or probably more profitable?
Yeah, so we'll go with monthly expiry. 25th is the monthly expiry for Nifty. 24th is the monthly expiry for Bank Nifty, being Thursday and Wednesday respectively. So I'll go with monthly expiry of 25th of July for all these trades.
We also have with us Feroz Aziz, Deputy CEO at Anand Rathi Wealth, joining in. Hi Feroz, thanks for joining in. It's Amina. It's been exciting. The last few weeks, the last few months have been exciting, but let's not forget that after many, many years, this is the first budget that a coalition government is going to be unveiling for us. From somebody who's tracked so many of these budgets historically, what do you think is the expectation today? What is a wish list from a market participant and from somebody who advises long-term investors?
Good afternoon, Samina. To my mind, like you rightly said, this is the first maiden budget of this coalition government. Of course, it's not like a pure play coalition government because the majority, of course, the 272 mark was not crossed, but I think it's still a powerful government. So I personally, from a capital market standpoint, have 2-3 expectations, not from a tax standpoint, but from an economy standpoint. The first expectation is the fiscal consolidation should continue. That's first expectation. The second expectation I have is the capital expenditure implementation of the 11 lakh odd crores, which is 11% growth. That should happen efficiently. That's the second expectation. The third expectation is the last term, the disinvestment targets were not met. But this time around, I hope the disinvestment targets get met. 36,000 crores is what was the average disinvestment, as against 65,000 crores, which was targeted. So these are the 3 broader expectations. But from a fiscal consolidation standpoint, if I dwell deep into it, I personally think that the fiscal deficit targets are being met, and actually first time ever, but very few times have we kept our fiscal deficit numbers down by 1 lakh crores, which I think is brilliant. The tax collection on the GST side, the growth has slowed down, but the direct tax collection is expected to grow at 13%. So that should support fiscal consolidation. I personally think prudence with respect to fiscal deficit is very critical for the FIIs to see this economy as a far more positive economy over the next 10-15 years. And that, I think, in this term has to get more and more established and reinforced for foreign investors to become more sticky, unlike the last few months.
Right, Feroz, I'll spend some time talking about capital expenditure because I think that's going to be very critical for the markets. But just before I go into that, there was that bumper dividend payout by the RBI. How do you feel this money is going to be used and spent? Is it going to have a significant impact on reduction in market borrowings, you think? And hence, that then has a follow-on effect on the debt market and then equities as well?
Sabina, in my opinion, of course, the dividend has been 2.1 lakh crore as against 0.9 lakh crore just the previous year. Of course, it's a lakh and 20,000 crore more of dividend. And I think the PSU banks dividends have also been very good and they are expected to be good. But I don't see this as one of the tool or one of the lever which can bring down borrowing of the government. I think the borrowing, net borrowing of 11 odd lakh crores will happen because the expenditure is going to grow and the budget size is going to be almost about 47.66 lakh crores, growing by about 7.3% vis-a-vis the 44.4 lakh crore, which is the provisional number so far for the last fiscal. So net what I'm saying is this extra dividend will be cushioning the expenditure increase of about 7.3% and the borrowing of 11.5 lakh crores, net borrowing, and the gross borrowing of 14.1 lakh crore may remain. But it's still the yields will be softened because of our inclusion in the bond index. $12 billion have come from September after globally. I think another $18 billion is expected. So I think the yields on the long end of the yield curve may not rise in spite of the borrowing remaining elevated, given the fact that RBI has given a larger dividend, but I don't expect net borrowing to come down, Samina. And I think it's a brilliant question, and that's what the debt market is looking at.
Firoz, the space that's been most excited ahead of the interim budget, ahead of the elections, and now, of course, the final main budget has been PSU stocks. And when I say PSU, specifically mean railway, defense, and fertilizer. It's been so tough to read what these stocks are getting up. And of course, Chandan may have a better idea on the charts. But fundamentally, do you feel like the markets are getting ahead of themselves in terms of expectations? Or do you feel this budget is going to be all about growth, development, and sectors like defense, railway, and fertilizers?
Yes, I think they have definitely from a valuation standpoint, and if you look at that as the dimension, of course, they've gone ahead in terms of what valuations you would want to give these companies and these sectors, definitely ahead of time and ahead of earnings for sure. But second point is, I think these stocks, free floats have already been gobbled out, and I think the free float available for people to grab is very low. That's why every unit of rupee invested in these stocks is resulting in a re-rating. Unless this liquidity cycle gets broken, I think this whole fundamental being looked at is going to be a far-fetched thing. So we are tracking the liquidity in these sectors very closely. Like if you look at the SBI Infrastructure Fund, which is the largest AMC's infrastructure fund, I look at its inflows every day. Unless this inflow, like yesterday, there was about 100 crore inflow, 75, 80 crore inflow, if I'm not wrong. So what is going to happen is, unless this cycle of liquidity breaks, fundamentals will not be looked at. So the focus will shift as soon as this starts taking a breather. So we at Anand Rathi, we've been very clear, be the broader market or be these hot sectors, we would be the first ones to pass the pillow as soon as the tide of liquidity turns, and then the fundamentals take the primary seat in terms of the valuations. I think till that happens, I think I would be ignoring valuations for some more time, maybe a couple of months or 6 months, or even as latest as 1 week later, if the liquidity dries up, reality will sink in.
Well, no one knows whether reality is valuations anymore, right? I mean, it just seems like they're in a little bit of a unicorn world in that sense. Chandan, how do you feel about it? You know, historically, we've always seen fertilizer, railway stocks do well ahead of the budget. This time around, you've got defense names. In the last 2 years, they've been such an important and significant part of where money has been coming into in the broader markets. Today is no different. Stocks like RVNL, IRFC, IRCTC, RailTel doing exceptionally well. If you don't, so this is a two-part question. If you own these stocks in railway and defense, what do? Do you take profits off the table ahead of the budget? Or if you don't own these stocks, would you recommend buying fresh or opening fresh positions in any of those railway, defense, fertilizer stocks between now and the 23rd of July?
So we have positive view on the entire Nifty CPSE index. That means it combines defense, shipping, railway, PSU banks, even fertilizers, power and energies. And we believe that most of these sectors are likely to do well given the price structure. We are bullish in the entire CPSE from last couple of quarters. And most of the sector and stock have really done well. Still, I believe the momentum could continue here. The way the flow and the sentiment, the setup is clearly visible on the chart basis. So I believe one can continue to hold the shipping name or defense name, whether we talk about HAL, BL or counter like Paras, BDL, even in railway, positive on the IRCTC, RVNL, IRCON, positive name on most of the fertilizer names. And I think monsoon progress will also aid the momentum and the positive stance here. In fact, if you want, the couple of names from housing, finance, infra, and construction could be in focus. Companies like NBCC, Hoodco, IREDA, all these stocks will be in focus in the Nifty CPSE. Those who are holding, they can continue to hold the position with the view that further 10 to 20% run-up could continue. Those who are looking to it, they can also definitely be here. I believe this sector, which has already seen the good momentum and strength is there, that is likely to continue. So one can be here. And I believe some sort of alpha generation could be seen here for the next 1 month to 3 months in the market.
Right, Chandan, sorry, I'm just going to try and, make this a little more specific. So if one has to build out a concentrated portfolio on the trading side between now and the budget and pick stocks from the sectors we discussed, give me 3 to 4 names that you would, add significant wealth to, because if you've got to see a significant movement, then you will have to have a relatively large allocation to these 3 to 4 stocks. So 3 or 4 stocks in the sectors we mentioned.
Yeah, so I think I've discussed a couple of sector here and stock as well. So if you want me to include the 3 to 5 name, first I'll go with HL, Hindustan.
Top 3 to 5 stocks.
Yeah, so I'll go with HL. However, the stock has really done well, but still we have potential upside of 20-30% from current level. So one I can select from defense, that is HL. Positive view on NBCC. So here expecting further momentum. Just a couple of days back, it gave a major breakout on the daily and the weekly chart, and it has potential to rally towards 250 level. So HL is the first name, NBCC is the second name. In fertilizer, I'll go with the FACT. FACT has really seen the narrow range breakout on the weekly chart. Even on the monthly basis, we have seen good run up in the last month, and now after the consolidative move of 10-12 days, again some attraction is clearly visible. So 1250 kind of target could be seen here. Apart from that, when we talk about the budget, capital allocations need to keep in mind. So I cannot ignore the capital goods name, and in that I'll select the L&T with the view this is going to be the major beneficiary, whether there is a benefit in the defense or order or anything related to the capital infrastructure. So L&T will be fourth name, and one more I can select in the EV, whether you talk about Olectra or any other. So these are the couple of stocks I think one should take to play the budget theme, with the view that budget will be for India and focus will be the infrastructure, focus will be growth for the country, and focus will be on Skill India or Make in India or making defense more progressive in the country.
Right. Very lastly, Feroz, what is the advice to medium and long-term investors? Should they consider tweaking their portfolio as you go into this budget, or do you feel like while it may induce a little bit of volatility, the long-term vision and portfolio should remain the same?
I think there are 3 pieces of advice for a long-term and a medium-term investor. Medium-term, by which I mean 3-year plus. Long-term, by which I imply 5 to 6 years. The first one is your equity exposures can still be higher. If you don't have for your 5 years money is greater than 70-75% in equity, I think there is still a very important increase in allocation needed. So I would not recommend anybody to be less than 70-75% for 5 years monies into equity. Making money in debt is not going to be so easy. Even if interest rates were to come down, the long end of the yield curve will not make you too much money because it's not gone up. That's point 1. Point 2, if you have been in the broader market, which is mid cap and small cap, it is time to take some money off the table. Quite a few people have been negative from last October in terms of valuation, but I think liquidity has brought them here. I think taking some money off the table and still the broader markets will do well. But if your allocations in small caps have exceeded more than 25%, you would have to bring it back below 25% and about 20-25% in mid cap and 50-55% in large cap. I think that's the second piece of recommendation. Third, please don't put your money, long-term monies, into thematic schemes. Because the themes are very popular and diversified funds are also exposing themselves to several sectors which are actually being independently launched as sector funds. I see several retail investors buying sector funds. I think that's something which is avoidable at these current valuation levels. Looking at 3 derivative indicators, I would say the market is now grasping for breath. And that kind of rally on 4th June, of course, I was very positive, unlike most. But I think now the FII long positions have exceeded 84%, which is a great sign of a reversal or at least a breather. So don't get too carried away with the rally which we have seen this expiry from 4th June, the last expiry from 4th June on the election.
Keep your emotions out of this. I think that's probably one of the most important lessons one needs to learn when it comes to investing in these very euphoric markets. But at least for now, the going's looking good. Thank you, gentlemen. Good talking to both of you, getting some perspective on what the market would like to see from this budget and how you should be trading and creating a portfolio at a time when uncertainty will start picking up. Well, talking about expectations, let's go across now to Mahima. She's got a report where she's analyzed from Jefferies on what their expectation is from the budget. Mahima?
Right, Samina. So the budget is always a tightrope between, for the government to choose from spending on capex or spending on the welfare schemes. But considering the amount of income tax inflow that the government has received and the kind of RBI dividend that the government sits on, Jefferies has come out with its budget expectations. They're saying that the government can please everyone with the kind of, like I mentioned, with the kind of dividend that they have, with higher capex as well as some kind of social welfare schemes. They're also saying that they should bring positive for several domestic sectors, and these sectors include something like consumer durables, retail, etc. But they're saying that IT and pharma could lack triggers. Now, what they're saying is that the fiscal deficit is expected to be around 5% for FY24, and buoyant collection may lead to income tax cuts. Now, in terms of sectors that could benefit from the FY25 budget that is going to be announced on July 23rd, discretionary, telecom and retail are set to benefit. Now, in terms of consumer discretionary, they're saying that the budget will be on the lookout for whether the government adopts for populist schemes or not, and the income tax collections that have seen buoyancy so far in the past 5 years, some fiscal space for tax cut might be there. Now, in terms of consumer discretionary, durables and retails, there are certain stocks that Jefferies is bullish on. In the consumer discretionary space, when we talk about stocks, they are bullish on stocks like Jubilant FoodWorks, Devyani International, Zomato, Nykaa and Honasa. In the telecom space, they are particularly bullish on Bharti Airtel. In terms of consumer durables, they are bullish on stocks like V-Guard, Crompton and Havells, and retailers, they are bullish on stocks like Trent, RIL and Maruti Suzuki. Now, in terms of housing and finance, Jefferies is saying that the government is likely to bring interest subsidy for urban housing, and a reduction in borrowing target might be positive for developers as well as NBFCs. Now, a few stocks that they've mentioned that could benefit from this include Aavas Financing, Home First Finance. These are the two NBFCs, and then some builders like Lodha and Sunteck Realty could benefit from this. Now, in terms of the capex and welfare, they're saying that they expect 20% growth benefiting companies like L&T. Health insurance expansion is likely to include all senior citizens going forward, and rural infra and welfare schemes will, some kind of boost is expected there as well. So stocks like TVS Motors, Hero, M&M and HUL could benefit from this. And lastly, they're also expecting some kind of taxation change for tobacco, which could be more than 5 to 7%, and this could be positive for ITC, which could be less than 5 to 7%, and this could be positive for ITC as it will aid growth in terms of volumes for their cigarette business. So this is the overall view of what Jefferies is expecting from budget that is due in July.
Yes, it's all excitement and, of course, anticipation of what gets unveiled at this much anticipated coalition budget that will be unveiled on the 23rd of July. Up and from now until then, we will, of course, take you through what every sector, every specific industry would be seeking from their wish list. We'll wrap up the show, but while we take that break, we caught up with Saurabh Gupta of Dixon Tech earlier today to understand from him what he expects from the sector in terms of PLI schemes. And H.M. Bangur of Shree Cement as well talks to us about his expectations.
Like any industry, we've also given a wish list to the finance minister, and there have been a lot of articles, media news lately. So we expect a couple of things. One, we expect that the reduced taxation rate of 15%, which was earlier applicable and later on it was last financial year or this financial year it ended. We want the government to renew it for the manufacturing sector. So reduced taxation of 15% should come in for the manufacturing companies. Second, I would say that a lot of PLIs have been there for the finished products. So we expect that the government might come out with another PLI for specifically for electronic components, critical electronic components, because a large part of imports is still being done through of those electronic components. So we expect that the government will come out with a PLI for electronic components. So these are the two things which we expect, and among a lot of smaller things as well. Yeah.
Private sector wants to grow at a much faster speed, and because of various old policies, the capital is not being absorbed as fast as people want to invest. Right. It is the fastest growing economy at present, so we will like to be part of it. For example, environment